Our portfolios performed very well in the first quarter of 2026. In addition to our overweight to energy, part of the reason for this was the ongoing de-rating of many of the high-flying growth stocks, a bit like what's happening to many of the software names, both here and in the US. I've previously shown a chart of some of these de-ratings. Today, I want to put this in more tangible terms by comparing the market capitalisation of two top 10 stocks, ANZ Bank and CSL. When COVID struck in the beginning of 2020, CSL was the biggest stock in our equity market, with a market capitalisation of over 150 billion Australian dollars. As I've previously highlighted, at the time it was trading on very rich valuations. For example, a price-earnings ratio, or PE, of almost 50 times. Contrast this to ANZ Bank, the smallest of the big four trading banks. In March 2020, ANZ had a market capitalisation of just $40 billion and was trading on very inexpensive multiples, approximately 10 times PE and less than book value. Not surprisingly, at that time, our portfolios held zero CSL and plenty of ANZ. In fact, in market cap terms, one CSL was the equivalent of almost 4 ANZ banks. Fast forward to today, and it is hard to believe the difference. Today, ANZ has a market cap approaching $120 billion, i.e. up threefold, while CSL's market cap is below $70 billion, i.e. it has more than halved. So it is not far off today where ANZ almost buys two CSLs. Now, when the valuations change, we change our positioning. We held no CSL back in 2020, and today it is a modest overweight position. We still hold ANZ, but frankly that is more a reflection on how expensive the other three big banks are. So CBA, Westpac and NAB are trading. So valuation matters. And when valuations change, we change our position accordingly.